What are the three things holding back the stock market right now? So in this video, I'm going to talk about the three things that are holding back the stock market these days. And before doing that, if you're an expat or a high net wealth individual in particular, go over to adamfayed.com and see how I can help you. Now, the three main things I see which are holding back the stock market right now are interest rates, obviously. So right now, we saw a few days ago, the Federal Reserve increased interest rates by 0.75% again. And the market is looking at where is the top going to be. There's no certainty at the moment. Is it going to be 4%? Is it going to be 5%? And that's going to be a big thing. If the Federal Reserve pivots, in other words, they start to decrease interest rates, as Paul Krugman, the Nobel Prize winning economist, expects and some others do, that's likely to support asset prices. But by the same token, once the market actually knows where our interest rates are going to be, at least that's going to take away some uncertainty. What's very interesting is in the last few months, when the Fed's been more aggressive, the markets have sometimes been up because it sounds counterintuitive, but basically I think what the markets are most worried about is uncertainty. Are we going to 3.5, 4, 4.5, 5? Once we get certainty one way or the other, I think that could actually be good for markets. Number two is an economic slowdown, which is linked to the first point. So obviously if there's an economic slowdown, but that leads to stimulus and interest rates going down, that could be good for markets. But by the same token, if we're in a situation where interest rates are high, we're in a recession, especially if it's a deep recession, but the central banks don't decrease interest rates to fight that, that could actually be bad for asset prices for 1 or 2 years at least. But we never know what's going to happen, right? I mean, in the UK, it's expected that the new Prime Minister, Liz Truss, will actually try to stimulate the housing market by taking away some of the stamp duty, which is like a buying tax. And you never know what governments can do to kind of stimulate the economy. But the point is these two issues, interest rates and also the issue that I just alluded to, which is basically the potential of inflation and recession and so on. These two issues go hand in hand and they're worrisome basically for markets. And number three, obviously, things that are outside of the control in some cases of central banks and some policymakers, things like the war in Ukraine as well. Having said that, I think a lot of bad news is already priced in, right? So you can imagine if there was a ceasefire announced next week or in 2 weeks in Ukraine and Russia, or something happened to the upside, like there was a good inflation report that showed inflation was going down, you could imagine there would be kind of quite a huge rally. But as I've said many times before, you never really know how markets are going to react because there's so many unknown unknowns and known unknowns that basically timing the market is almost impossible. But I think during moments like this, it's even harder to time the market. People intrinsically think, well, in extraordinary times, it's probably a bit easier to time the market because there's more volatility going up and down. But by the same token, as we saw in 2020, that can make it harder to time the market. So if we go back to 2020, markets fell quite a lot, obviously hugely, 50%, then they made a huge upswing and they recovered from that particular period. But in October of 2020, they had a pretty bad month. And then in November, they had an incredible month. And what's interesting is, coming into November 2020, people were very pessimistic about a disputed election, Trump and Biden and so on. And markets actually soared the day after the US election, even though it was clear that Trump wasn't going to accept the outcome of the election and it was going to be disputed. And that was about a week or two before the vaccine was announced, which led to markets going higher. So basically, markets reacted in the opposite way to what people were expecting. Likewise, you can go back in history, and when there's been a government shutdown in the US, markets have actually traditionally gone up. I think during the Cuban Missile Crisis as well, even though it's such a serious time, markets went up, and there's been other periods where markets have gone down very unexpectedly. Very few people were expecting, for example, a 50% fall at the beginning of 2020. So at the end of the day, we don't know what's going to happen. That's why just the normal strategies I've talked about before, dollar cost averaging into the market, investing when you can, not timing the markets, reinvesting dividends, they're always going to be applicable. I do think there's a chance of much more volatility. The chance of seeing, say, a 20 or 30% rise from here or fall in the next few months are obviously higher than normal because of all the things that are going on. But obviously stay the course. But I think right now, those are the three things that are basically holding back markets that people are worried about as well, amongst other issues as well.